8 public companies just loaded $2 billion of XRP onto their balance sheets. Fidelity minted its own stablecoin. The OCC told banks, go do crypto. The SEC dropped every major exchange lawsuit. And Utah had a Bitcoin reserve bill on the 1 yard line and fumbled it. 5 massive developments, one video. Let's get into it. 8 publicly traded companies have collectively committed over $2 billion in XRP strategic Treasury reserves, led by Evernorth Capital, which calls itself the MicroStrategy of XRP, alongside firms spanning fintech, healthcare, gaming, and agriculture. The trend mirrors Bitcoin's corporate treasury playbook, but introduces new dynamics unique to XRP's utility and yield potential. So look, you all know the MicroStrategy playbook at this point, right? Michael Saylor loads up on Bitcoin, the stock rips, everybody wins. Or at least that's the pitch. Well, now 8 public companies are running that exact same play, but with XRP. And we're talking about serious capital here, over $2 billion committed. Now, the biggest name is Evernorth Capital, and honestly, these guys are not being subtle about it. They literally call themselves the MicroStrategy of XRP. They've got $1 billion in capital commitments, they're holding 388 million XRP tokens, and they just debuted on the NASDAQ under the ticker XRPN. I mean, that's a statement. And it's not just one company doing this. You've got SBI Holdings out of Japan, Trident Digital throwing in 500 million, WeBus International with 300 million. Then there's Wellgistics Health. And this is interesting. They're the first US healthcare company to put XRP on their balance sheet. $50 million. A healthcare company. You've got a Japanese gaming giant called Gumi, backed by SBI, putting in 17 million. And even an ag tech firm called Nature's Miracle doing 20 million. So this is spreading across industries now. Now, here's where I have to pump the brakes a little, right? Because not everyone thinks this is genius. Charles Edwards over at Capriole Investments called these digital asset treasury companies, and I quote, a leverage explosion waiting to happen. He compared them to the investment trusts of the 1920s. And if you know your history, you know how that ended. Evernorth is actually sitting on a $380 million unrealized loss right now. The Motley Fool flat out said, don't invest in crypto treasury companies. But here's the thing the critics are missing. XRP is not Bitcoin when it comes to this playbook. Bitcoin just sits there. XRP settles in seconds. It supports lending, liquidity pools, validator participation. There are actual yield opportunities that Bitcoin doesn't have. So the question isn't whether this is risky, because obviously it is. The question is whether XRP's utility makes the risk-reward fundamentally different from just buying and holding. Fidelity Investments, managing $6.4 trillion in discretionary assets and $16.4 trillion in total assets under administration, officially launched the Fidelity Digital Dollar, FIDD, on Ethereum on February 4th, 2026. Backed by cash, cash equivalents, and short-term U.S. Treasuries under the Federal Genius Act framework, FIDD is available to both retail and institutional investors. This is the single largest traditional financial institution to ever issue its own stablecoin. So look, Fidelity, the company your parents probably have their 401k with, just launched its own stablecoin. Let that sink in for a second. We're talking about a firm managing $6.4 trillion in assets, and they just said, yeah, we're minting digital dollars on Ethereum now. Now here's the thing, right? Their president, Michael Riley, basically said this was, quote, the logical next step. And honestly, when you think about it, he's not wrong. They already do custody, they already do crypto trading, They have the Bitcoin ETF. So why not issue the dollar that settles all of it? And the timing is actually wild because the Genius Act, that federal stablecoin law signed in mid 2025, basically rolled out the red carpet for exactly this kind of move. Fidelity's publishing their reserve data every single business day, backed by treasuries, fully transparent. Now, will FIDD actually dethrone Tether or USDC? I mean, let's be real. Tether has 60% of the market, USDC has about 25%. PayPal launched PYUSD, and Ripple launched RLUSD, and neither one has even cracked 10% of Circle's market cap. So the skeptics are saying this is just more noise from a big brand. But here's what the skeptics are missing. Fidelity doesn't need to win the stablecoin war. They need a stablecoin to build everything else on top of. Tokenized treasuries, on-chain settlement, institutional collateral management. O'Reilly literally said having a stablecoin opens the door for other financial services to be built on-chain. That's the real play. The Office of the Comptroller of the Currency has systematically dismantled the regulatory walls that kept federally chartered banks out of crypto. Through a series of interpretive letters in 2025, the OCC cleared national banks to custody digital assets, execute crypto trades, pay blockchain gas fees, and even apply for dedicated crypto-focused national trust bank charters. 5 firms, including Ripple, BitGo, Fidelity, Paxos, and Circle, received conditional charter approvals in December 2025. So look, this is one of those stories that sounds like a headline, but is actually way bigger than people realize. The OCC, the agency that literally supervises every national bank in America, just said, "You're good, go do crypto." And I'm not talking about some vague guidance, right? They issued a whole series of interpretive letters throughout 2025 that specifically say banks can custody crypto, they can execute trades on behalf of customers, they can even pay blockchain gas fees and hold digital assets on their balance sheets. Now here's where it gets really interesting. In December, the OCC conditionally approved 5 national trust bank charters for crypto native firms. We're talking Ripple, BitGo, Fidelity Digital Assets, Paxos, and Circle. I mean, actually think about that for a second. Ripple and Circle are now on the path to becoming nationally chartered banks. And the acting comptroller, Rodney Hood, he didn't mince words. He said, and I quote, "Fair access is something I take very seriously. Customers engaging in lawful activities should have access to financial services, including our digital assets customers." He literally called the old debanking practices repugnant and odious. So yeah, we went from regulators saying, "Don't touch crypto," to the guy running the OCC calling it repugnant that banks were shutting crypto companies out. Quite the pivot, honestly. But here's the thing everyone's missing. The traditional banking lobby is not happy. The Bank Policy Institute came out and said, this leaves substantial unanswered questions. And look, they have a point, right? Because these trust bank charters don't come with FDIC insurance. They can't take deposits. So what happens when a crypto winter hits and these entities are operating under a federal charter without the same safety net? That's a real question nobody's answering yet. And one of the most dramatic regulatory reversals in financial history, the SEC abandoned its crusade to force crypto platforms to register as traditional exchanges. Acting Chairman Mark Ueda publicly called the previous approach a heavy-handed mistake, and within months, the agency dropped lawsuits against Coinbase, Binance, and Kraken. But what looks like a victory lap for crypto might be hiding some serious risks underneath. So here's the thing. The SEC basically did a complete 180 on crypto exchanges, right? Acting Chair Mark Ueda got up in front of a room full of international bankers in March 2025 and actually called the old approach, and I quote, a heavy-handed attempt to tamp down the crypto market. Now think about that for a second. The agency that spent years dragging Coinbase and Binance through court just walked away. They dropped the Coinbase case, the Binance case, the Kraken case, all with prejudice, meaning they can never refile those charges. And look, Brian Armstrong said Coinbase spent $50 million fighting that lawsuit. So honestly, you can understand why he called it bogus. But here's where it gets really interesting. Democrats in Congress are now saying, wait a minute, crypto firms donated $85 million to Trump's campaign, and every single company that got their case dropped gave at least $1 million to his inauguration. I mean, Maxine Waters literally used the words pay-to-play scheme. So now the question is, did the SEC actually see the light on regulation, or did they just follow the money? And actually, the bigger picture here is Paul Atkins, the new permanent SEC chair, just launched something called Project Crypto with the CFTC in January 2026 to build a whole new framework from scratch. So we're not talking about no regulation. We're talking about a complete reset of the rules. Utah was supposed to be the first state in America to hold Bitcoin in its treasury. The bill had momentum, political backing, and a supermajority in committee. Then, right at the finish line, lawmakers gutted the single most important provision, and what's left tells a very different story about how states are actually approaching crypto. So here's what happened in Utah, right? They had this bill, HB 230, the Blockchain and Digital Innovation Amendments. And originally, it would have let the state treasurer put up to 5% of public reserve funds into Bitcoin, like actual state money into actual Bitcoin. And this thing was flying through the legislature. It passed the House. The Satoshi Action Fund was calling Utah the front runner in the whole state Bitcoin reserve race. And then, in the final Senate reading, they just stripped it out. Gone. Now look, what's left in the bill is fine, I guess. You get the right to self-custody your crypto. You can mine Bitcoin, run a node, do staking, and the state can't mess with you. Cool. But here's the thing. That's not a strategic reserve. That's a participation trophy. And honestly, the real tell was Utah's own state treasurer, Marlo Oaks, who basically said the quiet part out loud. He warned that even having the option to invest in crypto would create, quote, undue pressure on the treasurer's office. So the guy who would actually manage the money didn't want the responsibility. Now, meanwhile, New Hampshire actually went and did it, signed their reserve bill into law in May 2025, became the first state. Texas followed. Governor Abbott signed SB 21, and they literally bought $5 million of Bitcoin through a BlackRock ETF in November. So Utah had the head start and still lost the race. I mean, when even Arizona's governor, who vetoed 2 crypto bills, still ended up signing a reserve fund for unclaimed digital assets, you know Utah's cautious approach looks a little extra cautious. So look, let's just step back and take all 5 of these together, right? Companies are loading XRP onto their balance sheets like it's a corporate strategy. Fidelity is minting stablecoins on Ethereum. The OCC is handing out bank charters to crypto firms. The SEC dropped every major lawsuit and is rebuilding the rules from scratch. And even the states that don't pass Bitcoin reserves are still enshrining your right to hold and use crypto. I mean, this isn't one headline. This is an entire financial system being rewired in real time. The wall between crypto and traditional finance, it's not crumbling. It's already gone. The only question now is, are you positioned for what comes next? If this breakdown was useful, smash that subscribe button, drop your take in the comments, and I'll see you in the next one.